Hi, this is Jason Kelly with the Kelly Letter, here to talk to you today about the 30 down rule with the Kelly Letter plans. Here's how it works. I'm in the Kelly Letter user guide now on the subscriber site. I'm going to jump down to the 30 down rule. This is how it's explained in the user guide. The 30 down rule locks the plans in place after a 30% drop for maximum profit in the recovery that has always followed such drops. The idea here is a psychological one, that when the market's down 30%, all the news is terrible, the future is bleak, we're never going to come out of this, you've seen it before. But it's hard to stick with the plan during that, so we have a rule that actually makes it happen, that you just follow the plan. You tune out the media and do what the plan says. In this case, the plans lock in place for the recovery that has always followed such big drops. Media will pretend like this time there won't be a recovery, and maybe someday there won't. But so far in history, there always has been, and the plans are built on the assumption that there always will be. The funds used for the rule are SPY for the 3 sig plan, that's the S&P 500, no leverage there, 1x index. 6 sig uses MVV, which is the mid-cap 2x fund, and 9 sig uses TQQQ, which is the 3x leveraged NASDAQ 100 fund. The idea is the rule activates when the fund's quarterly closing price is at least 30% below its quarterly closing price high within the past 2 years. The wording here is very specific. Within the past 2 years, the quarterly closing price high is what we use to base this on, and then 30% below that is when the rule gets triggered. If there's a different price intra-quarter, we don't follow that. It has to be just the quarterly closing prices that we monitor here. When the rule is active, you will ignore sell signals as follows per plan. In 3 sig, 4 sell signals get ignored. 6 sig, 2 sell signals are ignored, and 9 sig, 2 sell signals are ignored. A sell signal ignored might happen in a row, but they could be interspersed with buy signals, and that's fine. The buy signals are followed as usual. So if the market keeps declining and the plans signal that we're supposed to buy more, then we'll go ahead and do that. But if the plans signal selling during this recovery phase, then we won't do that, and that's what these skip sell signals are all about. 4 of them for 3 sig, 2 for each of 6 sig and 9 sig. After you've ignored the specified number of sell signals and 2 years have passed per plan, in 3 sig, you do not reset but resume normal plan operations. In 6 sig, you reset to the base 60-40 stock bond allocation in the same way with 9 sig. Now, the rule is shown in every Sunday letter for subscribers. Here's how it looked in note 33 of 2018. That's a while back, so I'll show you a current one in a moment. In the case of 3 sig, SPY had to get below this price. In the case of 6 sig, MVV needed to go below this price. And in the case of 9 sig, TQQQ needed to go below this price. Let's come up to a recent note. This is actually last Sunday as of this recording, so that would have been October 20th, 2024. This is what the 30 down rule looked like for the 9 sig plan. If TQQQ, which at that time was $74.64 per share, ended the quarter below $51.67, the plan would have gone into its 30 down phase. And as you just saw, that means in the case of 9 sig that it would have ignored the next 2 sell signals within the next 2 years. Now, how does this look in real life? Well, here we are on a chart of TQQQ, and I want to show you 2 places when we did go into a 30 down rule in the last 5 years. You can see that nicely on this performance chart that's at the top of jasonkelly.com. You can see a current one there. This is the one current as of this recording, which is October 22nd, 2024. This is what it looked like then. And you can see in the lower right here in bold that this chart was as of October 18th, 2024. That was last Friday. Let me explain this a little bit. The red line is the Kelly letter, so it's all 3 of the growth plans, 3 sig, 6 sig, and 9 sig mixed together. That's what this red line shows. This blue line, S&P 500 via SPY, is underneath just to show the performance comparison. And both of these are by total performance. So that means also taking into account distributions from the plans, not just price change. All right, and in both cases, each line is a total performance line. Up here, there are three different actions that are monitored on this chart. Kelly letter rebalances, buy signals, and sell signals, and respectively black, blue, and gold. And then these lines come up to show what happened. The ones we want to focus on here are these rebalances. In this case, back here in 2020, and then up here we had another one in 2024. So that's what's pointing up here to these rebalances. And this line roughly tracks what you'll see with TQQQ. Not exactly, because we had other indexes in there, but long-term investors know stocks tend to move as a block. So basically, if one index is following a pattern, other stock indexes are going to be following a similar pattern. So back to how things went for TQQQ. We had this crash. This is the COVID crash over here. And after that crash, the plans did lock in place to be able to rise through this long ascent that followed. That's the recovery that followed. Huge crash, media freaking out, the future is bleak, get out of stocks, retreat to the sidelines. To offset that and guide you to do the right thing, the plans not only signal to buy, but signal to lock in place because there's probably a big recovery on the way. And sure enough, look at that. And so the reason the plans weren't selling along this line is because they were locked in place because of the 30 down rule. It's a wonderful rule, actually. It's made a lot of profit for our plans. Now, coming back to the Kelly letter chart, this is after the COVID crash. That would have been in spring 2020. So we crashed down there, and then you can see we're locked in for the 30 down phase here. And up here, finally, we get a signal to come out of the 30 down phase and rebalance. It's not always perfect. In fact, you can see it would have been better to rebalance up here, but move myself. But you do the best you can with these price signals, right? And it was pretty good. We locked in for this ascent here, rebalance here, and still got more of the ascent to follow. Then we had another big crash. This is the 2022 crash when the Fed panicked into cranking interest rates higher because it was worried about inflation. So this is the 2022 bear market, and you can see it on this chart as well. This is TQQQ again. So here we are, 2022, Fed panics, interest rates skyrocket, down goes the market to roughly the end of 2023. Would we have locked into a 30 down phase here? You bet. I'm talking about the 9 sig plan here. And sure enough, come back to this performance chart. There we go, down with 2022. We lock in with a 30 down ascent, and we're not selling here. If this had not been a 30 down phase, for example, in both cases, coming out of the COVID crash, we would have been selling on the way up as prices strengthened. But thanks to the 30 down rule, we locked in place to maximize the gains from the recovery. Same thing, we get another crash because of the interest rate panic of 22, and the recovery follows. As always, despite what media will tell you, we would have been selling on the ascent here if not for the 30 down rule locking us in place, and didn't end up rebalancing until we got up to this point, and that's what the arrow is pointing to, this rebalance up here. And then we rebalanced, and now heading higher with normal plan operations, not a 30 down rule. And the next time we get a crash, then we'll do another 30 down lock-in to maximize profits in the recovery that follows. I hope this helps. If you're not a Kelly Letter subscriber yet, why not? Head over to the top of jasonkelly.com and you can see the latest of this chart. If you are a Kelly Letter subscriber, thank you for watching, and I hope this helped you better understand what we're doing with the 30 down rule. Until next time.